Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, Professor of Economics at the Catholic University of Korea. Professor Young, good afternoon. Thank you for coming on today.
Happy to be here.
Well, let's start with the Federal Reserve and Chairman Powell's testimony in Congress on Wednesday. He says he still sees interest rate hikes coming at this month's FOMC meeting, likely 25 basis points. That could accelerate, he said, if inflation doesn't come down. Tell us about Powell's remarks and what you make of them.
Okay, well, as you mentioned in the last story, probably the item of most interest for traders was that they're ruling out the possibility of raising the interest rate by 0.50 percentage points in March. I think the market generally took that as very good news, at least for now. And I think they're at least opening the possibility that they might slow down the rise in interest rates over this year. It's not completely clear whether this was due to the Fed's desire to go relatively safely and slowly. They had implied that before that they will not raise the rates too quickly, or whether it was due to the recent uncertainties in Ukraine. But there were some concerns on how quickly the Fed will raise the rates. And I think with Ukraine, Fed now feels that it has to proceed a bit more slowly, and they have to keep an eye out on the data to see how things move because, well, basically what's happening now with the invasion in Ukraine, things have become, at least in the short term, unpredictable. The speech does not rule out the possibility of small but many increases over the year. But right now, the consensus on how many times the Fed will raise the rate seems to be centering between 5 to 7 times, whereas before some analysts were saying that the Fed may raise the rates as many as 9 times this year. And also, even though the Fed may slow the rate increases a bit, there is now, I think, a broad international consensus that the central banks need to raise the rates. UK and EU central banks have mentioned that they need to raise the rates. The Eurozone inflation rate is in the 5% range, the US in the 7.5% in January. So we will look at rates going up throughout the year. However, the IMF has placed some concerns that if the U.S. raises the rates too quickly, it may mean a lot of problems for emerging economies. For Korea, if the Fed raises the rates 5 to 7 times, there's question on whether the Bank of Korea, can keep pace with the United States and raise the rates at the same time. Korea has fundamentally weaker economy than United States. Korean inflation rate is high, but it's below the U.S. rate of 7.5%. Korea's January consumer price index inflation was only 3.6%, but Korea does have problems with household and corporate debt. Their debt to GDP ratio is higher than the United States, and it's growing faster than the United States. And Korea needs to somewhat keep pace with the U.S. in raising the interest rate. Otherwise, Korea risks having a rapid capital outflow. So Bank of Korea probably cannot match the U.S. rate increases 1-to-1. So it'll have to strategically decide when they will follow the United States in raising the rates and when they will skip the raising rates for this year.
Well, now a week into the war in Ukraine, oil prices continue to rise. On the NYMEX West Texas Intermediate for April, delivery rose 7% in the Wednesday session to above $110 a barrel, the highest level since 2011, and it's kept rising. Where do you see oil going, and what's the impact of these higher prices?
Okay, well, in the short term, the prices may be unpredictable. The exact amount that it bounces will have to depend on how badly the fighting goes and how much the international response will be. And the big question is, will Russia decide to restrict exports to pressure the Western economies? But so far, at least the Western governments have in their sanctions, carved out energy and grain to avoid accelerating the global inflation. But some major oil companies and traders are now refusing to buy Russian oil. They're moving into Middle Eastern oil, which raises the global price of oil overall, even though it may reduce the price of Russian oil. International energy agencies have announced that the members of the agencies, the countries, are releasing strategic reserves that probably will more than cover the Russian production falls in the Russian production in the short term. British Petroleum, Shell, ExxonMobil, they're all removing themselves from joint ventures and investment in Russia. So that will, in the medium term, have consequences on oil prices as well if this invasion lasts longer. And analysts are saying that Western Europe may not need Russian oil next year, so they will be dependent on it this year, and that's also going to affect the Russian oil future, the oil price futures. Another factor that is concerned here is that if the Western countries do not buy Russian oil and the price of Russian oil falls, China may buy it as a bargain. So all of these factors are making the prediction on where the oil prices are going a lot unpredictable right now, especially in the short term. Another factor that we may want to consider here is that a lot of the price rise that we see right now may also be a part of speculation. There's a lot of excess liquidity in the global market, and the stock market is falling, the Bitcoin market is falling, so that money may partially be going into the oil markets, and that will make the price rises or fall even more volatile.
Well, oil rising and stocks on Wall Street rising too in the last session by quite a bit for all three main indices in the range of 1.6 to 1.8%. Powell's remarks, as you mentioned, about a 0.25% rate hike this month, seeming to ease concerns about it being bigger than that. What's the story in the global equity markets?
Okay, well, the U.S. markets have been more or less on an upward trend since the February 23rd. That's the day after the invasion, even though the market fell quite a bit on the day of the invasion. And the rising trend is partially due to the sanctions being weaker than the market had feared before the invasion. As I mentioned before, the energy and grain exports have been carved out of the sanction measures, and the unified front shown by Western countries may have calmed the market a little bit because all the Western governments seem to be acting together, and traders are acting very carefully and conservatively. They seem to be avoiding risk, and perhaps because of this, they're shrugging off the oil price increases today, which hit above $100 per barrel. Though the way that the market is acting lately, they seem to be on a bit of a time delay. So it may hit the market a bit later, but at least for now, they seem to be feeling that this rise in oil prices may be temporary. As you said, the global markets are rising today because of the Powell testimony, and European markets yesterday have been rising as well, and they'll probably rise today based on the Powell testimony. In the Asian markets, what we see today is that Nikkei and Hang Seng was up about 0.7% and 0.6%. Respectively, but Shanghai market is basically level. They fell a little bit, but only by 0.09%.
Well, it seems like a similar story here today in Korea as well. The big names were up all across the board. Individuals were selling the Kospi while foreigners were buying. Tell us about the domestic market.
Okay, well, the Kospi and Kosdaq are following the U.S. and European trend. The Kospi and Kosdaq has been rising since the 24th, again, the day after the invasion. Tech markets have been doing very well. When the inflation is rising and there's a danger of rising interest rates, it's usually the tech stocks which fall, but tech stocks seem to be recovering. And again, that may be because the market is now interpreting that the Fed will slow down on its interest rate increases. Both Kospi and Kosdaq are now higher than it was at the end of 23rd, the day of the invasion. So you can argue that at least for now, the shock of the invasion, at least in the stock market, is over, though the things may become volatile again. For the week, there seems to be a movement for safe assets moving into bonds and U.S. dollar. U.S. dollar has appreciated quite a bit. It's over 1,200 won per dollar now. It ended today at 1,205 won per dollar. But if you just look at the figure for today, rather than look at the figure over the last week or so, then for today, the demand for safe assets fell just a little bit. The dollar was a bit weaker than it was yesterday. Kospi was up 1.6%. It ended today at 2,747.13. Year to date, though, they're down about 8%. Kosdaq, it was up 1.9% today. It ended today at 912.26. But year to date, they're down about 12%. This is about roughly the same as how the U.S. market is doing. Dow fell by about 7.4%, S&P by about 8.6%, NASDAQ by about 13% year to date. So Korean market seems to be roughly following where the U.S. market is going.
Got it. All right, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you.